Alrighty. So today I have another wheel strategy video for you guys, and I've polled you guys not too long ago asking you guys, what videos you would like me to create more of, and the number one most popular topic is on the wheel strategy. So I have a video for you today which is called the income grid wheel strategy, and the whole idea here is to consistently sell premium regardless if the market goes up, and more importantly if the market goes down, because we all know that the wheel strategy weakness is if you get filled on the cash to put and the market continues to go down, then you're in trouble because you have to just hold on to the stock until it finally comes up. So I've changed this wheel strategy slightly, all right, so that it becomes like an income grid, so that even though if the market drops or even crashes, you still can continue to sell premium, right? So I'm going to explain more on this on the later slide, but first of all, just have a quick recap on what the wheel strategy is. And if you're not familiar on what the wheel strategy is, it's actually a very simple strategy, right? You just start off by selling a cash secure put, right? A cash secure put just means that you have the money to fulfill the obligations to buy 100 shares of the underlying stock at the strike price which you sold this cash secure put. Now some people sell the cash secure put hopefully that do not want to get assigned, right? But if you do get assigned, right, you will get 100 shares, and then with the 100 shares you can then sell a covered call on it, right? So this covered call you can choose to sell at the same level which you sold the cash secured put. So this way all you're doing is just getting the premium from this two, right, the cash secured put and covered call. Or you could just sell the covered call above the cash secured put, which means you're actually selling the covered call above where you went long 100 shares. So this way you also get capital gains on the 100 shares which you bought. Right now, after selling the covered call, the aim here is to have the stock go above your covered call so that it expires in the money and your shares will be called away. So once your shares is called away, right, net you have zero position, and you do this all over again. So this is an income strategy, but the problem is that if the market continues to go down after you get filled on this 100 shares, you will realize it becomes hard to sell this cover call. But again, I'll go through this later on. So first of all, let's talk about this traditional wheel strategy, right? So the basis of this wheel strategy is to simply just sell a cash secure put at a single level. Then once if it's exercised, you sell the cover call, rinse and repeat, right? So for example, right, you take a look at the chart. So most people, when they enter into the wheel strategy, what they do is that they will try and use technical analysis, right? They will try and take a look at the chart and they see that, oh, this is in an uptrend, so I want to sell a cash secure put somewhere below the last low, right, the previous low, or below the moving average, or wherever it is that they think that the market would rebound after going back down for a while, right? Ideally they want to sell a cash secure put and that it never gets filled on the cash secure put. That means the market never goes below there, they never get assigned on the 100 shares, and they just get the premium, and they just want to keep doing this, right? So I'm going to give you an example. So let's say you have $10,000 in capital to use on the wheel strategy, right? So maybe this 10,000 is part of your big portfolio, or you just want to commit 10,000 to just a single stock for this stock to do the wheel strategy. Now this is on AT&T. Now first of all, I'm not saying that you should use it on AT&T. I'm just using this as an example because this is actually quite a low price stock, right? So this is easily doable with just $10,000, right? If you want to do this on Google, you definitely need much more money. You want to do this on Amazon or any other tech stocks that are much more expensive, right? $10,000 is definitely not enough. All right, so for this example, let's say you have identified that you want to sell the cash secure put at $19.50. So this is the level you want to sell your cash secure put at. So hopefully you want the stock to just stay above this cash secure put, right, at expiration. Then you just collect the premium, right? You don't have to go through the hassle of getting assigned on it. So if you have $10,000 in capital, what you'll be doing is you'll be selling 5 cash secure put, right? Because each cash secure put, right, let's say if you get fulfilled 100 shares of the underlying stock, you will need to put up $1,950 in capital. So it's roughly $2,000 per cash secure put, right? So since you have $10,000 in capital, you can afford up to 5 cash secure put. So even though if your 5 cash secure put gets assigned, you have the money, right? So this is the goal down here. So you sold the cash secure put, $19.50, you sell 5 of them. So let's say the stock goes down and it closes at $19 at expiration. So at this point of time, you will be assigned on the cash secure put, right? And then now you'll be long 500 shares. So at this point of time, what you want to do is you're going to sell 5 covered calls. So you're going to sell 5 covered calls. So in this example, I choose to sell it at the same strike price as where you sold the cash secured put. So in this case, all you're doing is just earning the premium from selling the cash secured put and the cover call. So total, you have like 10 short options that you're receiving premium on, which is going to be pretty nice in terms of income. So you sell the 5 cover calls at $19.50, and let's say if the stock goes up and closes above $19.50 at expiration, what's going to happen is that your shares is going to be called away, and then your position is back to zero, and then you do this all over again, right? So basically this is the ideal situation which you want when you're doing the wheel strategy, right? Now here's the problem. What if the stock actually continues to drop further and further after you got assigned on the 100 shares? So as you can see in this example, this is AT&T. What happened if you sold the cash secured put at $19.50? So as you can see, the market went all the way down here. So at this point, this is quite a big problem because it's going to be hard for you to sell a covered call now, right? If the market is way below your entry price of where you are now long 500 shares, you're not going to get much premium for selling the covered call. So what do you do in this case? There are only 2 options that you can do. If your current stock price right now is way below your entry price, you can only either cut loss, which is take the loss, which is something we all want to avoid when we are doing the wheel strategy, or to just simply hold on until the stock comes back up. But the problem is that you may have to hold for many years. In fact, I've spoken to some of you guys, I've spoken to some of my subscribers. They have emailed me regarding some of their situation. And this is not uncommon because the market has just recently crashed. Right now, we are in a bear market. So a lot of the positions which most people have is that they face something like this, right? So they are long somewhere almost at the highs, and then the market has just crashed all the way down, right? Certain stocks have even crashed more than 50%. So at this point of time, there really isn't much you can do if you don't really have any more capital, right? You could try and sell covered calls, right? At this point, let's say from this point, you could sell your covered calls below your entry price, but then you will be risking your stock to be locked in at a loss, because if there's suddenly going to be a rally, let's say there's some news out there, let's say maybe the Fed decided to ease up on a quantitative tightening, or suddenly the war stops, or whatever news that comes up that the market sees as very positive, the market can just suddenly rally, and it's going to rally past your covered call. And if it's going to rally very hard, very quickly, it's going to be difficult for you to roll up and out each time, because that is the only rolling strategy that you have, right? Just keep pushing to the further dated months and rolling to a higher strike price. But if your entry price is so far away from where the current stock price is, you could end up locking in the loss, right? So if you have a covered call at this point, this level down here, this covered call, and you realize that you can no longer roll out and up, then guess what? You have already locked in this loss from where you entered to where your shares will be potentially called away. So this is one of the big dilemmas that you face when you are doing the traditional wheel strategy, where you only enter with a single level. So what is the solution? Right, so the solution is the income grid wheel strategy, and this is what I'm personally using when I'm using the wheel strategy. By the way, if this video has been helpful so far, I'd appreciate if you hit the thumbs up button and also subscribe to my channel so I can create more videos like this for you in the future. Okay, back to the video. So this is the income grid wheel strategy. So the income grid wheel strategy, the difference is that you do not sell the cash secured put at just a single level. Instead, you sell the cash secured put at multiple levels, and we have multiple levels of cash secured put. It means that you can sell your covered call at multiple levels as well. So this way, you will always be able to sell premium even if the market crashes, right? So the whole idea is to just keep selling your cash secured put at different levels. So this way, regardless where the market is, there is always a chance for you to keep selling premium. So let's get into a similar example. So let's say you have $10,000 in capital as well. So again, remember, when you're using the traditional wheel or the income grid wheel strategy, the risk doesn't change, right? It doesn't mean that you're using the income grid. Therefore, if you're placing more multiple levels, you want to increase your risk. No, it shouldn't be that way. The first you always start off with is the risk risk, the maximum risk or the capital that you want to allocate to the wheel strategy, right? So it doesn't change. Always prioritize how much you want to allocate to the strategy first. So similarly, we have $10,000 in terms of capital to use for the income grid wheel. So instead of just placing all 5 cash account puts at just this single level, what we're going to do is we're going to split them into different levels, or rather, like, it's like grid, right? You have different levels throughout the stock levels, right? So you have level 1, which you will activate first because this is the closest to where the current market is. So you only sell the first cash account put at $19.50, just only 1 cash account put. So this way you still have more capital for level 2, 3, 4, and 5. So when the market goes below this cash account put, right? So at $19.50 is your cash account put. So if it goes below here, what you can do next is to activate the next level by selling the next cash account put. So you sell the next cash account put. Let's say you have decided that the second level is $2 away, right? So it will be at $17.50. So at this point of time, you can sell another cash account put at level 2, $17.50. And let's just say that the market just stays in within, just stays between these two lines, these two strike prices, and it expires there. So what happens is that your first cash account put at the first level, $19.50, it will be assigned and you will be long 100 shares. At the same time, your cash account put at the level 2, $17.50, it will expire worthless. So you have captured the full premium for this. At the same time, you already received the premium for the first cash account put down here. So what do you do right now? So what you can do right now is to do a covered strangle, right? So I've covered this in a previous video. If you haven't watched that, go ahead to watch that. I'll put the link at the top right hand corner. But basically, the covered strangle is just simply selling a cash account put and a covered call at the same time, right? So you can just sell the covered call at $19.50, which you got assigned 100 shares on. And then you sell the cash account put again at $17.50. So this way you still get income. Okay? Now, what happens if the market crashes again? It just drops below your second level. Now, in the traditional wheel, what you are left with is that you're stuck with this position, right? You may be able only to sell the cover call one time, but then later on, it's going to be very difficult for you to sell the cover call at your entry price. Instead, you may have to resort to selling, below the entry price, which I don't really suggest because it can be, quite tricky, especially if the market rallies. But then for the income grid wheel strategy, you still can utilize your other levels because you have already planned for the levels all the way down to $11.50. So it has only dropped to $16.50. So at this point of time, activate level 3 cash account put, sell it at $15.50 at this level, and then you have your third cash account put. So as you can see, if the market stays there at expiration, what's going to happen is that the first level is going to expire your cover call. So now you're still left with long 100 shares. And at this point, you cannot sell your cover call down here anymore because it's just too far away. It's not going to yield any premium, right? But then you have this second level cash account put, which got assigned. Now you can sell a covered call at this level. Right, so you can sell a cover call at this level and you can sell another cash account put at the $16.50 level. So now you're selling another covered strangle. So here you have level 3 activated again for you. So as you can see, when you do the income grid wheel strategy, you have pretty much factored in how far the market might crash, right? You do not know where the market will go, right? No one really knows. We can only kind of use technical analysis or indicators to just give us an indication of where it might go, but really no one will know, right? So especially now that the market is crashing, we are in a bear market, the market wants to go down. So when you use the income grid wheel strategy, you're kind of protecting yourself in a sense, right? So as you can see with AT&T, even though after the huge gap down and the market just continues to go down, guess what? You're not out of business in a sense, right? You can still continue to sell premium over and over again compared to if you were just stuck with the 500 shares previously. There's nothing you can do, right? You cannot sell any covered call. But in this case, notice that you still have 2 levels that you haven't used yet, right? So that means your mindset is going to be quite good, right, compared to if you had just 100 shares. So when I approach trading, mindset is actually very important, the psychology which you have, because if you had just all your cash account put so at this level, guess what, you're going to feel very painful as the market continues to crash, continues to tank, right? But if you have this income grid wheel strategy, you're not going to be that afraid, right? Because you have still more levels down there, because you know that no matter where the market goes, even though if it crashes down again further down, you're still always able to keep selling your premium, right? You can keep selling your cash account put at this level, level 2, level 3, level 4, level 5, over and over again. And you can even try and get some intrinsic value gains on your stock, right? Because as the market does rebound back up, let's say if the market rebounds back up, you could sell your covered call at above this entry price of $17.50. So let's say maybe you want to put a covered call at $18.50, and if the market, the stock really closes above this level, not only do you get all the premiums from the cash account put and the covered calls, but you also get the intrinsic value gain from where you entered at $17.50 to where your shares got caught away here, and then you can go ahead and sell another cash account put again. So basically, wherever the market goes, right, you have this grid that is already covering all the possible moves that the market can make, right? So you want to make this to, you know, as far down as you think the lowest the market can go, right? So let's say, for example, if you think the market at 50% is the area which you think that it's hard to go below, right, then you can put the last level at the 50% mark. But again, it all comes down to how you want to construct it. There's no one way that's better than the other. Alright, so as good as this income grid wheel strategy is, there's of course some cons as well. So I want to go through the pros and cons to compare both the traditional wheel and the income grid wheel, so you know exactly, you know, the difference between these two and which is more suitable for you. So let's first go through the pros for the traditional wheel strategy. So first off, the pros is that you make more money if the cash account put expires worthless, or if the market goes up after the cash account put is assigned, right? So you notice that, you know, when you sell the traditional wheel, you will go 5 cash account put, right, at one time. So let's say, for example, this is the stock, right? It comes down here, and then you sell the cash account put. There's 5 cash account put you sell because you have 10K capital, and the market really goes up, right? If you're good at market timing, the market goes up, guess what? You're going to receive the full premium on the 5 cash account put. So that is why you make more money compared to the income grid. Because remember, with the income grid, you are splitting it up into different levels, right? So the first level will never be fully using up your capital. So you will not be making more compared to the traditional wheel if the market goes up. Secondly, for the traditional wheel, it's not as capital intensive as income grid wheel, because you can just sell 1 cash account put. So for example, let's say if the stock is $100 and you have $10,000 in capital. So in this case, you can actually sell 1 cash account put on that stock, right? $100 times 100 shares, that's $10,000. So you can do the traditional wheel strategy there. But if you want to do the income grid wheel to have at least, you know, if you want 5 levels, that means you need $50,000. Or if you want 3 levels, you would need $30,000. So that's going to be very capital intensive for the income grid wheel compared to the traditional wheel. So traditional wheel is much less capital intensive, and it does better when the market is in an uptrend. As mentioned, if the market is in an uptrend, even though if the market goes past this cash account put, if it goes up again, doesn't go down further, then your 5 cash account put, right, just a single level, is going to do much better than the income grid wheel. So the traditional wheel, in a sense, what it does is that it prioritizes profits. That means all you are trying to focus on is how much money you can make. So that is why the traditional wheel is quite popular among a lot of people, because they want to try and get as much premium as they can upfront. Alright, so let's take a look at the income grid wheel, the pros. So for the income grid wheel, the pros is that there's no need to time the market well, as you have more room for error with many levels, right? So with the traditional wheel, since you have only a single level, you need to be pretty good with your market timing, right? Because if you enter the cash account put and the market starts crashing from there, then guess what? You're going to be stuck with a position, holding on to it until it finally recovers. But with the income grid, you have room for error because you have already have a plan for many levels below the first cash account put level. So this way, even though if the market continues to drop, you're actually happy, right? Because if the market drops, that's how you can actually start to make more income. Because as the market drops, you will get filled on the other levels. So because of this, you'll be able to always sell premium to get income, right? Even if the stock drops a lot. So especially if right now the market is going down, and then you have some positions that you know, you already did the wheel on and it's way up there, your entry price, there's nothing you can do. But with the income grid wheel, this prevents that from happening because you kind of factored in the worst case scenario, or rather a very bad scenario if the market crash. So this way you will keep selling income. There's always, you know, income coming in, money coming in as you sell this cash secured put and cover calls other levels. So this does better when the market is in a downtrend, right? So this is the opposite of traditional wheel. Traditional wheel, you want it to be an uptrend. Income grid wheel, you want it to be in a downtrend where the market keeps going down, which is the current market condition which we are in. So the income grid wheel is much better right now because it prioritizes risk. We do not think of the amount of money that we make, but rather the first priority that we think of is, oh, how far can the stock actually possibly drop if I'm wrong? So if I'm wrong, where do I want my lowest level to be? So this way I ensure that I still get some income as the stock drops, right? So it is a very different mindset from traditional wheel. Let's take a look at the cons for the traditional wheel. So for the cons, right, as mentioned, you need to time the market well, or the position may be stuck for a very long time. I've spoken to a few people. They have their position stuck since January or February of this year, which is about 7-8 months ago, and they can't sell a cover call at their entry level, right? So if you want to avoid that, then the income grid will be better. Now the cons of this is also that you're not able to sell any premium if the market drops a lot, right? So as I mentioned, if it's too far down, you cannot sell anything. And it's bigger risk to the downside because your average price is much higher, right? Now, what about the income grid? The cons of the income grid? Well, the cons is that you actually make less money if the market goes up after placing your first cash secured put level. So the psychology here for the income grid is that you actually do want the market to come down, because as the market comes down, you get to sell the other cash secured put level, and that's how you make your income. Ideally, you want all 5 levels to be activated so that you can keep selling the cash secured put and cover call all throughout as the market moves, right? With the traditional wheel, you pretty much have just one chance, right? One chance, one level, right? One level to make it right. And then if you're wrong on this and the market just crashes from there on, then there's not much you can do. But for the income grid wheel strategy, you have many levels, right? You can go 5, you can go 6, 7, up to the cost of the stock as well as how much capital you have. So this way, even though if you're wrong on the first one, it doesn't matter, right? Imagine if the market just moves this way throughout, right? You're just going to keep selling your cash secured put and cover call all throughout all this level as the market just goes up and down and just go back and forth like a pinball, doing nothing much. Even though it goes sideways, you're going to keep selling premium, keep receiving that income over time, and carry you through this tough period. So the cons is that less capital at work if the market doesn't drop to the last level. So at one of the things to try and maximize your profits is to always use your capital when it comes to investing, right? So that's why there's this dollar cost averaging. You want to always put in a consistent amount every single month. So this way you're always putting into the market and always have exposure to the market, so that in the long term you'll be making money, right, as the market goes up. But with the income grid, you only have, you're placing this level. So if the market just touches the first level and goes up, and every time this happens, you're only utilizing 20%. Let's say you have 5 levels, you're only using 20% of your capital at work. So you're only going to earn the return on the 20% capital, but you have 100% put into this whole trading investment, right? So your returns will not be as good as the traditional wheel. So again, there's a catch, right? There's always a trade-off. In an uptrend, traditional wheel is better. In a downtrend, income grid is better. If you are prioritizing profits, traditional wheel is better. You're going to get more off each level. But if you are prioritizing risk, you're worried about your downside, the income grid will be better because it really manages risk and ensures that you get income even though if the market crashes. Alright, so let's take a look at some takeaways. So the traditional wheel strategy is more aggressive in prioritizing profits, as mentioned earlier. But the income grid wheel strategy is more defensive, right? Your mindset is more towards, okay, how far can the market drop if I'm wrong on the first level, right? So it prioritizes risk. Next, the traditional wheel strategy requires better market timing because you only have one level to play with. So you need to be good at reading charts, seeing technical analysis, looking at indicators. right? But for the income grid wheel strategy, it gives more room for error, right? You don't have to be exactly right. In fact, you can just place the first level, and in fact, you want the market to drop so that you can utilize the other levels as well. So there's much more room for error, and timing is less of a concern when you use the income grid wheel strategy because you can plan your grid to very far down. Next, the traditional wheel strategy works better when the market is in an uptrend, right? So it maximizes profit at a single level, cash account put and covered call as well. But the income grid wheel strategy, it works better when the market is in a downtrend because that's when you'll be able to activate all the other levels. So this ensures an income even as the market drops a lot. So which one is better? The answer is that there isn't one that is better, but rather you want to choose one that suits your psychology the best, right? And of course, based on your capital and also the price of the stock, right? So if your concern is wanting to make the most profits, then you want to go with the traditional wheel strategy, right? This is the one that most people are using. Just sell one level. They can just have many different stocks and then just sell a single level. So this gives you the most profits. But if your concern is that the market is going to crash and potentially, having to hold on to the stock for a long time without being able to sell premium like right now, then you want to go with the income grid wheel strategy. So guys, what do you think about the income grid wheel strategy, and which do you think is more suited for you? So let me know in the comments below, and if you're interested to know more about this income grid wheel strategy, just type in the comments below, say that you're interested. This way I'll know, and maybe I'll just create another video where I'll go more in depth. I'll talk about the construction of the income grid. I'll share with you my own results with using this income grid wheel strategy, right? Just write in the comments below, say you're interested, so this way I'll know whether to create another video on it or not, right? Alright guys, so that's it for this video. I hope that you found this video helpful, and if it has, I'd appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching. I appreciate your time, and may the options favor you.